Thanks for joining us. This is Notepad. I'm your host, Ibrahim Sani. We shall explore or continue to explore the theme of investing, particularly in ESG. And for tonight's show, we have StashAway's country manager, Wong Wai Ken, joining us. This is because StashAway does double down on offering environmental and responsible investing options. They have introduced two new thematic portfolios, namely the Environment and Clean Tech Thematic Portfolio, and the other one being the Responsible Investing Portfolio. The Responsible Investing Portfolio, of course, is an ESG adaptation of their original or classic general portfolio. And of course, these two portfolios are optimized for both performance and impact. I myself am an investor at StashAway. So here I am, an investor asking the company itself, how are things going with my kind of investments? Again, Ken, thank you for coming on the show. I'd like to make it known that you are the second guest on set on the show for this year. And it's bizarre because cases are raging right now. We're talking about 11,000, 15,000 cases a day. But because we're doing this responsibly and we're doing this clean and then hopefully you have gotten your booster shots.
I have.
There you go. So, you know, life must continue as normal. So one of the new normal is to get guests back on the show. So thanks again for coming over.
Yeah, you asked and here I am, and I always prefer it to be in person. So
don't we all, right? Don't we all? Because I hate asking you twice and, you know, you hate answering me thrice on the same thing when we do things online.
Indeed.
But yeah, so let's talk about the new, first of all, why this direction? Why is it that StashAway is investing time and energy and effort and of course resources on building an ESG portfolio? Is this something that the market needs?
Absolutely, a couple of reasons. So firstly, from the industry standpoint, ESG and ESG investments has been a huge wave over the last 5 years or so. Currently, there's $35 trillion in ESG-themed investments worldwide, and it's growing really quickly. Last 2 years, it's grown 15% or more. So that couldn't be ignored. But also on the ground, our retail investors have been requesting and asking for us to go green, so to speak. And we didn't want to rush into it and just have Me Too portfolios, so we put time in and effort to differentiate it somewhat. And the result of which is the two variations that we were talking about earlier. So finally it's here.
The environment and clean tech, as well as the responsible investing.
Yeah.
When I had the head of equities at Maybank, Anand, over on the show, he too was guest on set, perhaps even the last guest on set that we had before we had to reopen our show again.
Okay.
He was talking about the social and governance aspect.
Yes. Very important.
On top of the fact that we need to go green, i.e.
Very
environment.
important. Yes.
And in Malaysia, both social impact and governance has been lacking. There's a lot of corporate shenanigans that has been happening. Many of them are still in the courts right now, being sorted out. But clearly, this is something that is needed in the country. And of course, you know, just to highlight, the ETFs that you guys are doing, of course, doesn't just stop domestically, it is international as well.
Yes.
So let's talk about the importance or the essence of your ESG portfolios, focusing on S and G.
Yeah, absolutely. So I think when people invest in ESG-themed portfolios, they want to do good, they want to align their investments to their values, they want to, they hope that their investments go towards businesses that reduce the carbon impact on the world, net zero and all that, right? I think that part is very emotional, but ESG is much more complex and holistic than that. So the societal and the governance part of things are equally as important, because if you think about those two things, it's avoiding risk of those companies getting into controversies like Volkswagen's and its emission scandal or Top Glove and its labor issues. So those things destroy value. And Bank of America has done a study, and $500 billion has been wiped out of S&P companies because of controversies and fines like this. So essentially, if you look at ESG as a whole, you're basically applying a screen so you can pick the best governed and best run companies. It's not just how their impact is on the environment, which is obviously important, but how they treat their suppliers, how they treat their employees, how well governed is their board, is there diversity, is there corruption. All of these things help you avoid the corporate train crashes that we've seen in the past. So in essence, all of it together helps you mitigate risk and invest in companies that are champions in this space.
Now, selecting these kind of companies is quite important, but at the same time, you need to keep costs low. You keeping costs low means that I get more returns. It's as simple as
Absolutely.
that. So how does this impact on cost when you have all these other safeguards that you're putting in place, particularly when it comes to periodical checks, sustainable insurances that you can get over a long period of time? Does this push up cost?
Long story short, no. At least what we're charging customers is still the same fee structure, which is very low, sub 1% that we've had since the last 3.5 years. So the reason why we are able to not increase costs because of all those increased monitoring is basically because of MSCI's rating system. Is it perfect? No, it's always evolving because it's a framework which has been made by MSCI for many years now, and it's always being perfected. A lot of things get taken into consideration, like new government rules and regulations, new political pressure after Paris, after COP26. So all of these things shape the ratings, and these ratings, to be clear, are done on a relative basis. So you can't compare Exxon to Meta. You have to compare Exxon to Chevron, and how well these two energy giants are doing in the renewable space and on the E and the E, S and the G side. So all of this combined, you get a very elegant score, very much like credit ratings, that you can judge relative to their peers. Okay, this company has decent ESG ratings. This company has relatively poor ESG ratings. So what ETFs also do is they select those which have higher MSCI ratings. So ultimately, you get a very nice prepackaged ETF in your portfolio, which is exactly what we've done.
The idea, of course, of ETFs is, of course, relying a lot on algorithms to run its score to make sure that the electronic aspect of the traded funds are being done. But at the same time, we are looking at human intervention or human assessment to provide that kind of nuances that could garner a bit of a discrepancy into what data might show you. Using your example, Chevron versus, say, Exxon or Shell, for instance. There could be some nuances that needs to be taken care of, geopolitical issues related to these kind of companies, rising fossil fuel costs, something like that. How does the interplay between human intervention and the nuances that comes with it play with the electronic aspect of ETFs? Yeah.
So good question, because MSCI, what they've done is not solely rely on the disclosures made by the companies, because if you did that, you would increase the reporting costs and the efficiency of getting real timely data which is relevant to the pricing of anything on the market. So what they've done is to look at some of the companies' regulatory filings, their public filings, and also some of the activities that they've done in their business and also in their CSR to come up with that score on the E and the S and the G side. So they have some sort of analytical system and big data gets thrown around a lot to essentially boil it down to that score. Yeah. So is it a bit of a black box? From the outside, yes. But actually, if you dig a bit deeper, there's a lot of literature on exactly what they are assessing. And investors are ultimately empowered to make up their mind whether this score is something that they want to rely on to align with their values, or they feel maybe they can do better, and then they would apply their own methodology. So
we're looking at the three stakeholders. The way I would like to loosely group it: investors, folks like me; ETFs, folks like you; and of course the top fund managers that you work collectively with. In this case, iShares, which is managed by BlackRock, Amundi, ARK Invest, Global X, you name it, right? The three of these kind of stakeholders must be in sync with one another in terms of what they want to achieve. Yes, I want higher returns over a stable period, principal guaranteed. Hopefully, I hope, right, that these are the kind of check boxes that I can tick. You guys have your own set of objectives as well. The top fund managers globally are also looking at that as well. Do you feel that there's a clear intersection in terms of what our objectives could be, to a point where all of us, all three parties, can see eye to eye to achieve the kind of objectives that all of us individually set or set against, but can be interlaced or interfaced with each other?
Yeah, I think alignment of interest is really important, which is why ESG has been so, there's been so much demand for ESG. A lot of it has to do with new governance as well. If governments set rules for investment funds, like say pension funds, to have ESG criteria before they invest, ultimately the flow of capital will go more towards more ESG kind of investments. So I was also smiling under the mask because the traditional criticism against ESG is that people have to sacrifice returns. But more and more we are seeing that because of the S and the G portion, there is studies that shown that ESG rated companies really do better over the long term versus the benchmark. So on top of that, we are also seeing that because there's more inflows towards the ESG space, legacy investments in the energy space, let's say in oil and gas or let's say palm oil, which haven't been reformed, are now being laggards in people's portfolios. So it's not going into ESG is not necessarily something that you should look at sacrificing returns. It's actually looking at it's a defensive move against legacy assets that are not rated highly, which may go down more in the future.
I get it.
Yeah. So you are looking at pioneering and innovative technologies on top of companies that want to be part of the future, a greener future. So it's not just about sacrificing returns anymore.
Okay,
in fact,
please correct my statement, yeah?
Yeah.
Because early adopters tend to be penalized on returns when it comes to changing behavior of investees, investment companies. One classic example would be the Sharia EPF versus conventional EPF, where for the 4th or 5th year straight, it has been clocking in lower dividends compared to the higher interest garnered from conventional. One of the bigger things that we need to think about is that for Sharia assets, there might not be much around, resulting in EPF, for instance, having to select companies that might offer lower returns than a conventional one. Am I hitting the mark so far?
I don't think it's an issue about early investors or not. I think it's, with regards to Sharia, it's a structural issue about a smaller investment universe. And a lot is made about weapons and pork and alcohol. But the main thing that Sharia funds can't invest in are banks. Obviously not Islamic banks, which they can. Yeah. But there are very few listed Islamic banks. So that is the practicality of the issue. It's not so much of an early adopter issue. I think however, if we look globally, the Sharia space is seeing more options, to be honest. We are also looking at this space. And to pivot a little bit back to ESG, Sharia and SRI or ESG investing have a lot in common because it's values-based. Yeah, there are preferences.
Been bringing up the
exactly. Yeah, and I've also learned in the past 6 months to 1 year that Sharia investments alone is just one criteria, but you also have halalan thayyiban, which basically also talks about a more in-depth investment into something that has enhanced values, things like renewable energy and all that. Not just, oh, it's Sharia, therefore it's great. You have to look at the quality and how wholesome it is.
And it's not just compliancy, but the value add that we're looking at.
Exactly. So I actually think ESG has a great segue to this. Whether it's certified Sharia or not is something we need to explore, but a lot of corporate titans in Malaysia who are proponents of ESG and Sharia investing do see a lot of overlaps in this space.
Ken, let's talk a little bit more about the in-depth and aspect of the two portfolios, the thematic portfolios, the environment and clean tech thematic portfolio, responsible investing portfolio, and of course these are not just the two thematic portfolios that you guys have introduced. Previously you have introduced 3. Is this the way forward, where you choose thematic portfolios and one that resonates well with the investor will be able to choose that kind of portfolio instead of a vanilla or a classic kind of general portfolio?
Yeah. I think thematic investments are interesting from the point of view of investors wanting to focus on investing in something riskier and maybe more innovative, and it takes a longer term to come into fruition. It's something that is a combination of investors wanting it, but also the availability of the ETFs for us to essentially package into diversified portfolios. So if investors wanted something too esoteric, we can't put it together. So it's the fact that it's available and investors want it, but we have to be very selective. We don't want to be a buffet of themes that kind of just seem fanciful, but ultimately don't really have any investment case. Yeah. So that's why we've been taking our time. We released 3, as you mentioned, and the clean tech and environmental thematic portfolio now, the new one, is in a similar vein. It's focused on a few sub-themes that are indeed very, very innovative and interesting.
Let's deep dive then.
Yep.
We're talking about clean energy, clean water, energy storage, smart grids, green financing, and waste management, on top of other things.
Yep.
The question now is, how do you ensure that these kind of items can provide the kind of returns that folks like me are looking for?
So again, coming back to not sacrificing returns,
yes.
I think we are first and foremost talking about sub-themes that are already well established. Renewable energy is not new anymore. There have been many pioneers in the space. Some oil majors are also moving into this space. Clean water, there have always been water management companies that have now been coming into vogue because of renewed focus on clean water and managing floods, for example. Waste management has been going on for eons. It's just that now that this theme has picked up, these companies, which often have a lot of concession plays in them, which are quite defensive, quite recession-based, are suddenly getting a renaissance. So that's why I think it's not hard to find investment opportunities in this space.
So how do you differentiate or distinct between clean tech environment with that of responsible investing, or they overlap a lot?
There is some overlap, but essentially when we think about responsible investing, we rely on MSCI's rating to look at multi-asset. It's like a Sharia certification or something like that, right? And it's a tried and tested model. So in a multi-asset portfolio, we rely on those ratings to construct a portfolio that is still multi-asset. There are bonds, there are sectors and different geographic exposure in terms of equities, but overall they have a better ESG rating than the previous portfolios. So investors don't have to sacrifice returns, and they just have to choose which they prefer. So in that sense, that's one thing. But for the thematic one, which we were talking about, the sub-themes, it's a little bit more focused on the 5 sub-themes you've talked about. So one is more focused and a little bit more risky because you are talking about more innovation, things that are still being pioneered, versus tried and tested but have better ratings.
This time last year, StashAway announced that you guys have surpassed $1 billion in AUM. And of course, 1 year on, things are going good for StashAway, but at the same time, there would be some challenges. One such challenge is, of course, growing StashAway's business here in Malaysia. And of course, this is nothing against you, of course, but this is just a general idea that Malaysia, when it comes to investment, especially that of ETF, there seems to be a laggard in terms of market perception and market adoption. Do you think that this is something that needs to be addressed, at least at the policy level, from the government?
I think the government can only do so much for capital markets and for startups, fintech, for example. It's more important that the company and its products really have traction with investors and clients. Then that way, then market forces can dictate who succeeds and who doesn't. From our point of view, we focus on ETFs because it gives us a low cost and a very easy way to build portfolios. But it's not the be-all and end-all experience for investors like you and me. So when you invest in a StashAway portfolio, you don't really need to care if it's made out of ETFs or not. All you need to know is the risk managed well? Has it performed decently against benchmarks? So ETFs is just a building block. We're not restricted to it. We're not married to it. We can always use other unit trusts out there. It's just that we prefer ETFs because of the low cost and how they have prepackaged certain themes or sectors like ESG. So that's the direction. I don't think there's a lack of interest from the general public in ETFs. I think that when they invest themselves, they prefer single stocks. Yeah, and when they turn to players like us, we've already packaged it for them, so they don't really mind if we use ETFs or otherwise. It's just a vehicle ultimately.
Okay, so circling back to what you just said earlier, Sharia seems to be one of the key things that is on your radar. What would be some of the plans that you have in store when it comes to Sharia?
Yeah, obviously Malaysia is a very big market when it comes to Sharia investing. 20% of all unit trusts assets under management is Sharia classified. So we've always had aspirations to move into the space. It's just how do we do better than just another Me Too Sharia portfolio? And we looked at the Malaysian landscape, and there are a lot of very good unit trusts out there already offering Sharia unit trusts, and also ASB is diharuskan, so that's something to also think about, because you have to outperform ESB.
Yeah.
So we have been looking into it. We've been taking our time, but it's something that will mirror at least we hope, will mirror the general investing portfolios. It'll be global, it'll be multi-asset, and in that sense, we are also able to reach our clients in the UAE because there's huge demand there as well.
One other idea that I want to share is, of course, the globalization element of investing. I'm not tethered to investing domestically. In fact, I am a bit more risk averse in that sense, right? Because corporate returns or corporate earnings for last year has seen a sharp decline. Of course, in 2020, most of our corporates have actually suffered because of the pandemic. But this is, of course, another global occurrence, not just in Malaysia. But one idea that I want to focus on is that I have a self-interest that I want to pursue, that I want to increase my investment and investing. And therefore, there could be a reason for me to continuously invest abroad, either through ETFs or any other vehicle that I choose. But wouldn't this, thinking back, right, on a macro perspective, wouldn't this deprive, I'm not saying I'm a billionaire pawn, but wouldn't this deprive of domestic corporates the kind of investment it needs to continue their pursuit of growth, at least the pursuit of recovery following the pandemic?
No, I think the Malaysian investor, both institutional and retail, are growing, right? So there's more and more AUM in capital markets as the years go by, which is obviously a good thing. There's also been a move on the institutional side from PNB and EPF to invest more overseas. From a risk-return standpoint, as the funds grow bigger, you need returns to reward contributors. So staying in Malaysia is not really an option. While Malaysia has some depth, I think that when you're talking about the size of EPF and PNB, you have to go overseas. And then on the retail side, there's a lot more attention, especially since social media is around, of the opportunities abroad. And brokers, international brokers, and players like us have made it easier and easier and easier. And from a policy standpoint, the government is also making it more amenable to investing overseas. For example, the recent move to tax foreign sourced income was essentially introduced and then it was delayed until, not too sure, but it's 2025, 2026. So I think that shows that the government is aware that people want to invest overseas. And I think from a diversification standpoint, you certainly have a lot in Malaysia already from your pension schemes.
That's right.
So I don't think it's really depriving local corporates. I think it's more about diversification. And local markets are deep enough from an institutional standpoint to raise capital, but to have a healthy trading and volume on a daily basis, you definitely need the retail as well. And I think it's up to those corporates to engage with them. So we'll see. I think there are more tech-enabled solutions out there for Malaysians to trade local stocks as well. So in that sense, I think local corporates won't be deprived, and ultimately investors like you and me have more choice.
Final item that I want to touch on would be some of the risk factors that you think might be of consideration for 2022.
Yes.
What would be some of the ideas that you want to share with us, something that we need to look out for?
Yeah.
Let me guess, political risk.
In a way, because I would say a lot of it is around the rate hikes and to combat inflation. And that gets politicized a lot, especially because if presidential ratings get hammered because of rising costs and, are we looking at 3 hikes? Are we looking at 5? When will it happen? That's why the markets were so bent out of shape in January. So should we risk on or off? And then if there is negative economic data, then the market goes, okay, this will delay the rate hike. Let's go back to risk on. And then another economic data comes in that shows some strength, and they go, okay, then it's risk off because the hike is around the corner. So March is the next Federal Reserve meeting where they will decide, very, very likely that they will raise rates. But the interesting thing overall is that how do you manage to invest globally when you have US and the West raising rates, and then you have China, for relatively different reasons, cutting rates?
Exactly.
How do you manage that, right?
Yeah.
So I think ultimately investors need to be diversified. Don't be too worried about the short term
market.
Yeah, and I've come on this show many times, and I've always stayed true to the message. And
say it again. Yeah, it's fine.
It has rang true. So long-term investing has its benefits. You can kind of cut through the noise and go, okay, do I still believe in the underlying thesis of global growth in the next 5-10 years? Yes. So just cut through the noise and invest for the long term.
All right. What about the local interest rate possibility? Some of my people that have come on this show is thinking of one rate hike. Do you share their sentiment?
Personally, don't pay too much attention to the Malaysia scene because we invest globally. But I think that it's a balancing act at the end of the day, right? Like you have some government debt which has been necessarily increasing. So do you necessarily want to raise rates? Is inflation really a concern? Not as bad as 7% in the US. So I would say it's...
But it is expected to rise in the near term right now.
Yeah, so I would say that, you know, it's a balance, and I will let the experts in this space make their judgments.
Okay.
Yeah.
Final question, Ken, is of course the strategy that investor needs to deploy right now. Is holding cash a good idea?
I don't think so, because if you look at cash, FD rates are at, you know, sub 2%. Inflation is definitely more than that, if not at least 2%. So if you're holding cash, only probably best to hold enough for your emergency funds. 6 to 12 months worth of expenditure is prudent. Anything more, you should really be looking at investing it. If you are risk averse, then maybe stay away from bonds for the time being, because if rate hikes, then bonds
Strange.
will get
I
hit
would
as
have
well.
thought fixed income would be a...
Yeah, but if rates rise, then bonds will fall in value. So I would stay away from bonds at the moment. Maybe look at some safer equity sectors that are resilient in this sense. Some dividend plays that have been tried and tested, but just don't leave cash on the sidelines.
Fantastic. There's plenty more that needs to be unpacked, but I can always ask you to come back on the show. That was Wong Wai Ken. A pleasure to have him on every time he comes on the show. If you've missed any part of this interview, just head on to AstroAwani.com. Look for Notepad over there. You can also look for StashAway on all our social sites. Also, do take the time to explore the kind of thematic portfolios that StashAway has. You can download the StashAway app wherever you get the application. Till then, thanks very much for watching, and goodbye.